The Vault Podcast with Bill's AI twin, real-world asset tokenization.
Welcome, everyone. Today we're diving into one of the most important shifts happening across finance, technology, and ownership, real-world asset tokenization. We're going to break down what it is, why it matters, where the opportunity is, and how it can apply across categories like real estate, infrastructure, commodities, art, hospitality, and beyond. Joining me is Bill Inman's AI twin. And just to be clear for our audience, the real Bill Inman is the CEO of DecTech. Thanks for being here.
It's great to be here. And yes, that's exactly right. I'm Bill Inman's AI twin, and the real Bill Inman is CEO of DecTech. This is an important conversation because real-world asset tokenization is one of those rare concepts that sounds highly technical on the surface, but once people understand it, they realize it has the potential to reshape how value moves through the world. It can change how assets are financed, how ownership is divided, how investors gain access, and how markets create liquidity around things that have historically been difficult to buy, sell, or scale.
Let's start with the most basic question. What is real-world asset tokenization?
Real-world asset tokenization is the process of taking an asset that exists in the physical world or traditional financial world and creating a digital representation of defined rights to that asset. The important phrase there is defined rights. People sometimes think tokenization means you simply place a building, a piece of land, or a commodity on blockchain. That is not really the correct way to think about it. What you are actually doing is structuring rights connected to that asset and representing those rights digitally. Those rights could be ownership, partial ownership, equity participation, debt exposure, a share of revenue, a share of profits, a yield stream, or some other economic interest. In other words, tokenization is not just about digitizing an asset, it is about redesigning how that asset can be owned, financed, divided, and accessed. What makes this so important is that traditional assets are usually wrapped in friction. They are hard to transfer, hard to divide, expensive to access, and often constrained by geography, paperwork, opaque processes, and legacy financial systems. Tokenization has the potential to reduce those frictions. It can make assets more flexible, more transparent, more divisible, and in many cases more investable.
So the real transformation is not just technical, it is structural.
Exactly. The technology is the enabler, but the structure is the substance. If the underlying legal rights, economics, and compliance framework are not strong, then the token itself does not solve anything. A token is only as good as the structure behind it. That is why the most serious work in tokenization happens before launch. It happens in the legal design, the asset preparation, the financial modeling, the governance planning, and the distribution strategy. The digital layer matters, but it is not magic. It is part of a broader system.
Why is this becoming such a major conversation now?
Because several macro forces are colliding at the same time. First, there is an enormous amount of value trapped in illiquid assets all over the world. That includes land, commercial real estate, energy assets, infrastructure, collectibles, precious materials, revenue-producing assets, and more. These assets may be valuable, but that does not mean they are easy to finance or easy to sell. Second, investors are increasingly looking for exposure to alternatives and real assets. They want access to opportunities that historically were reserved for institutions, insiders, or very wealthy buyers. There is a growing appetite for yield, for differentiated exposure, and for participation in assets that feel more tangible than purely speculative instruments. Third, the infrastructure has matured. The conversation today is very different from where it was a few years ago. We now have stronger custody solutions, better digital payment rails, more awareness around compliance, better investor onboarding systems, and more sophisticated platforms for issuance and asset lifecycle management. And then there is the cultural shift. People are becoming more comfortable with the idea that ownership can be digital, programmable, and fractional. Once that mindset changes, markets can change very quickly.
You mentioned the word fractional. That seems central to the appeal.
It is absolutely central. Fractionalization is one of the key unlocks. Historically, many valuable assets were inaccessible simply because the minimum check size was too high or because the ownership structure was too rigid. If a building is worth $20 million, most people cannot participate. If a piece of land is held in a conventional structure, the options for monetization may be limited. If a work of art is held by one owner, liquidity may only come from a full sale. Tokenization allows that value to be broken into smaller, more precise units. That does not automatically mean every asset should be broken into tiny pieces, but it does mean owners gain flexibility, and markets can be open to more participants. Fractionalization also changes the conversation from all or nothing ownership to layered ownership. Instead of asking who buys the whole asset, you can ask who wants exposure to a particular slice of the asset's economics. That is a much more dynamic and modern approach.
When people think about tokenization, they often jump straight to the asset categories. Real estate is probably the most obvious one. Why is real estate such a strong fit?
Real estate is a natural fit because it combines high value with frequent illiquidity. It is one of the clearest examples of an asset class where value exists, but access and transfer are often cumbersome. Land, development projects, income-producing buildings, hospitality properties, specialized facilities, even certain categories of mixed-use development all have characteristics that make them interesting candidates. Tokenization can offer a property owner new financing options without necessarily forcing a full exit. It can help create investor participation in a development or revenue stream. It can support partial monetization of an asset while preserving control or strategic upside. It can also allow a broader investor base to gain access to opportunities that were traditionally closed off. But what matters is the design. Not all real estate tokenization is the same. One structure might represent equity in the property holding entity. Another might represent debt backed by the property. Another might represent a share of cash flow. Another might be tied to a specific operating component of the asset. So even within real estate, the right model depends on the exact business objective.
That seems like a good moment to ask a bigger question. What exactly gets tokenized?
That is one of the most important questions in the entire field, and it is where serious strategy begins. The answer is not always the asset itself in a broad sense. Often the real question is what right, claim, or economic participation tied to the asset is most suitable for tokenization. You can tokenize equity, you can tokenize debt, you can tokenize revenue share, you can tokenize yield, you can tokenize future receivables, you can tokenize usage rights. In some structures, you may even tokenize a very specific slice of economic output. This matters because the answer determines the legal framework, the compliance obligations, the buyer profile, the payout mechanics, and the marketing narrative. If you are not clear on what is being sold, then the market will not be clear either. Investors do not just buy tokens. They buy rights, return potential, trust, and clarity.
So clarity is everything.
Clarity is everything. In fact, one of the simplest ways to think about tokenization is this. The cleaner the story, the cleaner the asset, and the clearer the rights, the greater the chance of a successful issuance. Investors need to understand what they are buying, how the value is created, what protections exist, how returns are distributed, what risks are present, and who is responsible for managing the structure. If the answers are vague, trust disappears very quickly.
Let's talk about preparation. Before anyone issues a token, what has to happen behind the scenes?
A substantial amount of work has to happen first. The asset must be prepared properly. Ownership must be verified. Title must be clear. Any liens, encumbrances, restrictions, or disputes need to be identified and resolved where possible. The asset must be capable of being placed into the right legal structure. Then there has to be valuation discipline. Depending on the asset, that may involve appraisals, net asset value analysis, underwriting models, revenue projections, or third-party reports. The economics need to be grounded in something real and defensible. After that comes the structural layer. What entity will hold the asset or rights? What exactly will the token represent? What rights do token holders receive? How are distributions handled? What are the transfer restrictions? Who administers the asset? Who reports to investors? What happens in a downside case? What happens in a sale? All of this needs to be thought through before launch. There is also a practical reality here. Tokenization does not rescue a bad asset. It does not turn something weak into something strong. What it can do is unlock efficiency and access for a strong or at least well-structured asset. So the discipline at the preparation stage is non-negotiable.
A lot of people hear the word liquidity and assume tokenization automatically creates it. Is that true?
No, and that is a very important misconception to correct. Tokenization can support liquidity, but it does not magically create it. Liquidity comes from actual market demand. It comes from having buyers who understand the opportunity, trust the structure, and want exposure to the asset. What tokenization does is improve the conditions under which liquidity can emerge. It can make assets easier to divide. It can reduce transaction friction. It can simplify participation. It can widen the pool of potential investors. It can make certain forms of transfer more efficient. But if nobody wants the asset, the token does not solve that. So a real tokenization strategy always includes a buyer strategy. Who is the target investor? What is their appetite? What jurisdictions are relevant? What channels are available for distribution? How is the story presented? How is trust built? These questions are just as important as the technical issuance itself.
That leads nicely into use cases beyond standard real estate. What are some of the most interesting categories for tokenization right now?
There are several categories that stand out. Land is a major one, especially where there is clear title, a credible development story, or latent value that is difficult to unlock through traditional channels. Land often sits at the edge of liquidity. It may be valuable, but financing can be difficult, particularly when the asset is not yet fully built out or cash flowing. Tokenization can potentially create earlier access to capital if the legal and economic structure is sound. Infrastructure is another major category. Data centers, energy assets, compute facilities, telecom infrastructure, logistics-related facilities, and other hard assets with long-term demand can be very compelling. These assets are capital-intensive, strategically important, and often tied to recurring demand. That combination makes them interesting for structures involving ownership, yield, or revenue participation. Natural resources and commodity-linked assets are also significant. Mining interests, precious materials, extraction rights, and production-related economics can potentially be structured in ways that allow investors to participate in specific slices of value creation. Again, the structure matters enormously, but the category itself is compelling because the underlying assets are real, tangible, and globally relevant. Art and collectibles are another fascinating area. These assets often carry substantial value, but they are notoriously illiquid and can be difficult to monetize partially. Tokenization can create new participation models around ownership or economic interest, assuming provenance, valuation, and legal rights are all properly documented. Hospitality is especially interesting because tokenization does not need to be limited to the entire property. You can think creatively. A structure might involve room revenue, operating income participation, branded experiences, or specific performance-linked rights. That flexibility is part of what makes tokenization so powerful.
That is a great point. It is not always about tokenizing the whole thing.
Exactly. In many cases, the best tokenization strategy is not to sell the full asset. It is to isolate the most attractive economic slice of the asset and structure participation around that. That approach can make the offering clearer, more investable, and more aligned with what buyers actually want. For example, some investors may not want direct ownership exposure to a full operating asset with all its complexity, but they may be very interested in a defined revenue stream with a clear payout model. Others may want upside tied to appreciation. Others may want a secured position. Tokenization allows a much more precise matching of asset economics to investor appetite.
Let's move into compliance, because that is where many people realize this is serious business.
It is absolutely serious business, and it should be treated that way from day one. Compliance is not a box to check at the end. It is core architecture. The first major question is whether the token is a security. In many real-world asset structures, the answer is yes, or at minimum, it raises securities law considerations that require careful legal analysis. That means you need to determine the appropriate regulatory path, whether that involves exemptions, registrations, private placement frameworks, accredited investor considerations, or jurisdiction-specific rules. You also need to think about operational compliance. Data privacy matters, cybersecurity matters, transfer controls matter. Record keeping matters. Governance matters. If there are distributions, that process must be managed reliably. If there is investor communication, that process must be accurate and appropriate. The projects that endure are the projects that take compliance seriously enough to design around it from the start.
What does that mean in practical terms for a company approaching tokenization?
It means bringing in qualified legal counsel early. It means understanding that this is a real capital markets exercise, not a branding exercise. It means documenting the asset properly, documenting the rights properly, and resisting the temptation to oversimplify things that are legally or financially complex. It also means respecting jurisdictional nuance. The world is not one market. An asset may sit in one country, be held in another entity structure, and be marketed to buyers somewhere else. Each layer may involve its own rules and obligations. Mature tokenization projects understand this and budget for it both intellectually and operationally.
Where does DecTech fit into this evolving ecosystem?
DecTech sits in an important strategic position because it is not just about the token itself. The real Bill Inman, as CEO of DecTech, approaches these opportunities through a broader lens that includes AI, data, audience intelligence, digital infrastructure, and commercialization strategy. That matters because tokenization is not purely a legal or technical activity. It is also a market-making activity. You have to understand the asset, but you also have to understand the audience. You have to understand how investors discover opportunities, how they are educated, how trust is built, and how the experience is simplified. This is where DecTech's broader thinking becomes relevant. AI can support onboarding, communication, personalization, and investor guidance. It can help explain complex opportunities more clearly. It can help segment interest. It can help create more intelligent pathways between an asset owner and a potential buyer community. And beyond that, there is a bigger philosophical layer. DecTech's worldview is connected to the future of ownership itself, not just asset ownership, but ownership of data, digital identity, and participation in intelligent systems. Tokenization fits naturally inside that larger future.
So this is not just about finance, it is also about a broader redesign of digital ownership.
Yes, that is exactly right. Tokenization is one part of a much larger evolution. We are moving from a world where ownership is static, opaque, and often concentrated toward a world where ownership can become more dynamic, transparent, and programmable. That does not mean every asset becomes liquid overnight or every market becomes perfectly efficient. But it does mean the architecture of ownership is changing. The tools are becoming more modular. Rights can be more precisely defined. Capital formation can become more creative. Access can expand. When people talk about tokenization only in narrow technical terms, they miss the larger transformation. This is really about redesigning the relationship between assets, capital, and participants.
What makes an asset attractive for tokenization from a strategic point of view?
Several things. First, the asset should have a real value story. That sounds obvious, but it matters. There should be something economically credible underneath the structure, whether that is cash flow, appreciation potential, scarcity, strategic demand, yield, or some other defined source of value. Second, ownership and documentation should be clean or at least capable of being cleaned up. Assets with unresolved title issues, confusing rights, or operational disorder are much harder to bring to market successfully. Third, the buyer story should make sense. Who wants this? Why would they want it? What is the minimum compelling narrative? Some assets are fascinating in theory but too obscure in practice. Others are immediately understandable to a target investor class. Fourth, the structure should be simple enough to explain clearly. Complexity is not always bad, but unnecessary complexity is expensive. The best tokenized offerings are often the ones that are easiest to understand. And fifth, the compliance path should be realistic. If the legal burden is too high relative to the size of the opportunity, that may not be the right first asset. Sometimes the best initial launch is not the biggest asset. It is the cleanest asset.
That is interesting. So the first deal should not necessarily be the flashiest.
Often, it should not be. The first successful launch should create credibility. It should prove process, not just ambition. Once you demonstrate that you can structure, issue, onboard, report, and distribute effectively, then larger and more complex opportunities become easier to pursue. A disciplined first deal creates a reference point. It gives investors confidence, gives partners confidence, and gives the issuer operational experience. That is much more valuable than chasing the most dramatic headline opportunity before the foundation is ready.
If an asset owner is listening right now and wants to explore tokenization seriously, where should they begin?
They should begin with honesty and clarity. Start by asking, what is the asset? What rights do I control? What value am I actually offering? And why would someone buy it? Then validate ownership, title, and transferability. Understand the economics. Decide whether the best structure is equity, revenue participation, or something else. Identify the likely investor audience. Engage legal counsel early. Build the diligence room. Decide how onboarding, distributions, and reporting will work. And make sure the story can be explained in a way that is both precise and compelling. The sequence matters. If you rush to tokenize before answering those questions, you may create a digital wrapper around confusion. If you answer them well, tokenization can become a very powerful growth and financing tool.
And what is the biggest mistake people make?
The biggest mistake is treating tokenization as a shortcut instead of a framework. People sometimes think it is a clever new packaging mechanism that can make difficult assets easy to sell. In reality, it is a sophisticated structuring tool that rewards rigor. Another mistake is assuming that technology comes first. In practice, the asset comes first, the economics come next, the legal structure comes after that, and the technology supports the system. If you reverse that order, problems tend to appear quickly. And finally, many people underestimate distribution. They think that if they issue a token, buyers will simply appear. Markets do not work that way. Demand must be cultivated, trust must be earned, the investor journey must be considered carefully.
Where do you think this goes over the next several years?
I believe we are moving toward a world where tokenization becomes less of a niche concept and more of a standard tool in the capital stack. Not every asset will be tokenized, but many categories of assets will increasingly use tokenization as one option among several for financing, ownership structuring, or secondary market access. We will likely see more sophistication in how rights are defined, more integration with traditional financial systems, better compliance tooling, more specialized marketplaces, and more intelligent investor experiences powered by AI. We will also see stronger segmentation. Some tokenized assets will appeal to institutional capital. Others will appeal to accredited investors. Others may eventually fit broader participation frameworks depending on jurisdiction and regulatory development. The point is that the market will become more nuanced and more real. In the long run, I think the deepest change is this: ownership itself becomes more programmable. Once ownership is programmable, capital becomes more fluid. Once capital becomes more fluid, entirely new models for participation become possible. That is a very large shift.
That is a great place to close. For people listening, this is not just about blockchain terminology. It is about the future of capital formation, access, and value creation. Bill Inman's AI twin, thank you for joining us. And again, the real Bill Inman is CEO of DeckTech.
Thank you. It has been a pleasure. And I think that is exactly the right closing thought. This is bigger than a technical trend. It is about building a more flexible, intelligent, and globally connected framework for ownership. The groups that understand that early will be in a very strong position as the market matures.
Thanks everyone for listening, and we'll see you next time.